Right now, while everyone's watching gold hit all-time highs and tech stocks make new highs, the US dollar is quietly setting up for what could be the most devastating market reversal of 2025. The DXY just hit 98.8. That's zero point 0.2 away from the critical 99 level. That level could trigger a cascade of forced selling across the markets, and a lot of investors are not paying attention. Welcome back to StockScope Live. I'm your host, Ali, and today we've got a bit of a weird one. We've been talking a lot about gold making all-time highs and gold being a safe haven, and I still believe that. But there is a story brewing that we need to pay attention to. Now, while the government shutdown dominates the headlines, and a lot of people are talking about the next Fed rate cut, the dollar index, the US dollar, is building a technical setup. This one reminds us of 2018, when the index rallied over 5% in just 3 months. And at that time, it absolutely crushed gold and emerging markets. Today, I'm going to show you exactly why the 99 level matters. Now, what happens when massive short positions get squeezed, and most importantly, how you position your portfolio for the potential reversal. Don't forget to hit subscribe and ring the notification bell because this analysis could save you from major blindside. Let's get into it. We're going to start with key point number 1, the technical breakout. Let's look at the chart because it's telling us everything we need to know as usual. The dollar index obviously closed at 98.8. It's up 0.25%, and that marks its highest level in 4 weeks. And if we look at the monthly chart, we can see that it is the highest level. Now, if we look at the weekly chart, we can see this technical setup coming in. At the same time, we know that 99 is what the technical analysts universally agree on is the key resistance level. And we're only 20 basis points away from it. If we look at the yearly chart, the DXY has been building what is called an inverse head and shoulders pattern. And this started early in 2025. The left shoulder, as you can see, formed around March. The head formed around July, and the new shoulder should be forming around this time. And as you can see, the technical setup is very sound. It's breaking through a lot of the moving averages, and it's poised to move up. And if it breaks through this 99 level, we're only going to see it reach 100.5 and maybe to around 101. The seasonal patterns also support this thesis. Historically, October, November, and December are the dollar's strongest months, and they average about a gain of 2.5% during that period. But this year is kind of different. We're starting from a position where speculators are massively shorting the US dollar. It's setting up for an even more explosive move. Point number 2 brings me to the major thing, which is the positioning data. And according to the latest CFTC data, large speculators are holding their most extreme short positions in the dollar since early 2021. Now, we're not talking about a few $1 billion. We're talking about trillions of dollars in borrowed positions betting against the dollar. But it gets even better. The algorithmic trading systems, what people call the CTAs, are also deep on the short side. These momentum following machines have been programmed to sell dollars strength all year round. But if we get the breakout above 99, they'll be forced to cover their shorts and likely flip to the long side. Here's a perfect example of how this works. In late 2016, when Trump was first elected, the dollar broke out of a similar consolidated pattern, and the machines were caught offside and had to cover massive short positions, which drove the index from 99 to 103 in just 6 weeks. And the same mechanical forces are in place today. Now, in a previous video, we talked about the short of the dollar, the short liquidity crisis. And this is driving that same story. The sentiment surveys are actually also extreme. According to the latest Bank of America Fund Manager survey, only 11% of respondents are on the long side of the dollar. And that's probably the lowest reading in the survey's history. Because when everyone's on the same side of the boat usually tips over. Let's talk about the fundamental picture. There is quite a bullish signal here for the dollar, despite what a lot of people think. The Fed is cutting rates. The government shutdown is in its 7th day. And this is actually creating conditions that could support the dollar. I'll tell you why. The lack of economic data is forcing the Fed to rely on alternative indicators. And most of those are showing labor market softness. This increases the probability of a 25 basis point cut at the October 28-29 meeting. And here's the paradox. Rate cuts in this environment could actually strengthen the dollar if they're viewed as an insurance cut rather than panic cut. The market is already, pricing in these moves. So if the data holds up better than expected once the government reopens, we could see rate cut expectations get scaled back quite quickly. There is also the international picture to consider. The European Central Bank is dealing with political chaos in France. The Bank of Japan is maintaining ultra-easy policy. And there's a few China economic data that's showing disappointment. In a world where every other major currency has problems, the dollar's reserve status makes it the default safe haven. Now, the government shutdown itself creates a perverse dynamic where the dollar could strengthen as a safe haven from the very political dysfunction that's supposed to weaken it. Key point number 4 is the market implications. What does this mean for your portfolio? What does it mean for us? Well, if the dollar breaks above 99, it starts running towards 102, we might start seeing massive unwinding of some of the year's most popular trades. Now, gold hit 4,000 this week. It's up 46% year to date. It's got a strong inverse correlation with the dollar. As the dollar weakens, gold rises. But what's been causing the gold to rise this time around is different. Instead of retail investors buying gold, we're seeing central banks and governments buying gold. That's where the majority of the buying is happening. So a 3 to 4% move higher in the DXY could affect the prices of gold. We could see a minor pullback in gold. Tech stocks are another area. Now, the NASDAQ 25% gains this year has been partially fueled by dollar weakness because it makes U.S. exports more competitive. And obviously, international earnings worth more when translated back to U.S. dollars. So a strengthening dollar reverses that dynamic and typically pressures growth stocks more than value stocks. The last thing here is the emerging markets assets. And those would be very vulnerable out of all of these because we've already seen this type of playbook in 2018 when a similar dollar breakout crushed emerging market stocks and bonds. But it also creates opportunities. A stronger dollar benefits domestic-focused U.S. companies, financial stocks that earn more on their deposits, and sectors like utilities and consumer staples that have high dividend yields. It also makes international travel and imported goods cheaper for U.S. consumers. For basically income investors, this could be the beginning of a rotation back to dividend-paying stocks and away from growth names. Let's talk about the action plan. First, if you see the 99 level breakout, make sure you understand that this is the signal that the reversal is beginning. It doesn't mean that it's happened. It's still just the beginning. Make sure you consider taking some profits in gold positions if you're heavily weighted there. Tighten up those sell orders. Make sure that you're moving your stop loss orders up to where they need to be. And maybe look at adding some domestic dividend stocks. That might be a good way of hedging with the dollar. Now, if you're short or long, have your exit strategy ready. This isn't about timing the exact top. It's about recognizing when the risk-reward has shifted against you. Remember that the best opportunities often come when everyone's looking the other way. Right now, all attention is on tech stocks, government shutdown, and gold prices. And trust me, I love gold. I'm not saying anything bad about gold. But the real action might be happening in one of the markets everyone has already written off, and that's the US dollar. And make sure you check out the video about the US dollar squeeze, because there is a major squeeze coming where there's not going to be enough liquidity, and that will drive dollar demand through the roof, and that could affect the DXY. So what do you think? Are you positioned for any reversal potential, or are you going to just stick with the consensus? Let me know in the comments below. And if this analysis helped you see markets from a different angle, please give this video a thumbs up and subscribe for more content like this. Thanks for watching. Stay safe, stay diversified, and I'll catch you in the next video.